Welcome to the Torch Academy. In this episode, we're covering 8 concrete things that increase or destroy your business value. These 8 areas determine whether a buyer sees your business as a premium asset or a risky acquisition. We will start with the first 4. Recurring revenue is gold. It is predictable and sticky. Growth is attractive. Investors pay for growth, not just current earnings. Margins show efficiency and pricing power. And owner independence is critical. A buyer does not want to buy you as a job, they want a business that runs without you. Each of these can be improved. They are not fixed, and they compound with each other. Coming up next, we will cover the other 4. Continuing through the 8 value drivers. Customer diversification reduces risk. No single customer should be over 15 to 20% of revenue. Documented systems make the business transferable instead of depending on knowledge in your head. A strong, capable team enables growth and reduces owner dependency. And market position, brand, unique service, customer loyalty, creates defensibility. Together, these 4 drivers can add 60 to 100% to your multiple. Recurring revenue is the single biggest driver of business value. Here is why. Transactional businesses are always chasing new customers. Revenue is unpredictable. Margins are squeezed because you are constantly in sales mode. A recurring revenue business has a predictable, sticky revenue base. You only need to grow 10% to see 10% growth. That is mathematically beautiful. How do you get there? Start converting one-time projects to annual retainers. Offer subscription versions of your service. Lock in longer-term contracts. If you are a consultant, move from hourly work to annual retention. If you are a service business, build a maintenance or subscription model. Timeline is real. This takes 3 to 12 months to implement meaningfully. But the payoff is enormous. Recurring revenue businesses command multiples 20 to 40% higher than transactional ones. Growth is the second big value driver. A buyer looks at 2 businesses with identical current earnings. One is flat. One is growing 20% annually. The buyer immediately values the growing business much higher. Why? The trajectory. You are not buying what the business makes today. You are buying what it will make in the future. To drive growth, improve your sales and marketing, build partnerships, expand into adjacent services, enter new markets, scale. Timeline. Meaningful growth takes 6 to 24 months to establish a pattern. But once you show consistent growth, your multiple jumps. A business growing 15% or more gets a 20 to 50% multiple premium. Margins are pure leverage. A business operating at 20% margins is worth twice as much as a business at 10% margins, all else equal. Why? Because every dollar of revenue generates more profit. How do you improve margins? Negotiate better supplier deals. Raise prices. Most businesses are underpriced. Improve efficiency. Get rid of low-margin customers or services dragging you down. Automate expensive processes. Some improvements are immediate. Price increases can happen this month. Others take 6 months. But the impact is enormous. Each 5% improvement in margins increases business value 15 to 20%. This is critical and often overlooked. If your business is you, customers buy from you, you do the work, the business falls apart without you. Then you have a 20 to 40% multiple discount. Buyers do not want to buy a job. They want to buy a business. How do you fix this? Move your work to team members. Document everything so it is not in your head. Build customer relationships with your team. Create systems and checklists. Reduce your own hours progressively. Promote capable people to leadership. The timeline is 6 to 12 months. You are gradually making yourself less essential. The payoff is enormous. Removing owner dependency can add 30% or more to business value. This is one of the highest ROI improvements you can make. Let me hit the last 4 quickly. Customer diversification. If one customer is 40% of revenue, that is a serious risk. Work to diversify. No single customer should be over 15 to 20%. That improves your multiple by 10 to 20%. Documented systems. Write down how you price, how you onboard customers, how you deliver, how you hire. This makes your business transferable instead of dependent on knowledge in your head. That is worth 15 to 25% premium. Strong team. Identify capable people and develop them. Build leadership depth. A strong team enables growth and means the business does not depend on you. Worth 20 to 30%. Market position. Are you the clear leader in your niche? Do you have a brand? Are your customers loyal? Competitive advantage is worth 15 to 25% premium. Here is the magic of compound improvement. You start with $300,000 in earnings at a 2.5 times multiple. Your business is worth $750,000. Over a year, you implement several improvements. You move 30% of revenue to recurring contracts. Your multiple jumps from 2.5 to 2.8. You improve margins by 3% through efficiency. Multiple to 3. You achieve 15% growth. Multiple to 3.5. At the same time, your earnings grew 15% to $345,000. Now your value is $345,000 times 3.5, which is $1,207,500. You have increased business value by 61% in 1 year. Same owner, same core business. Just deliberate improvement in the 8 value drivers. This is the flip side nobody wants to think about. Every value driver can be destroyed quickly. If you had recurring contracts and a key customer decides not to renew, you lose predictability. Value drops. If you lose a major customer, your revenue shrinks and risk increases. Value drops 15 to 30%. If you lose a key employee, the business is suddenly owner-dependent again. Value drops 10 to 25%. Or, if you step back in to do work yourself, you have undone all the owner independence work. The value driver swing can be fast and painful. This is why continuous improvement matters. You cannot just build these things once and leave them. You have to maintain them. Prioritize based on your timeline. If you are selling in 6 to 12 months, focus on removing owner dependency. That has the fastest ROI. Build recurring revenue contracts. Improve margins quickly through cost cuts and pricing. Document systems so nothing is in your head. If you have 18 to 24 months, add growth initiatives, develop your team more systematically, and diversify customers. If you have 2+ years, implement all 8 methodically. Build a genuinely premium asset. The timeline affects your strategy, but the principle is the same. Deliberate improvement in these 8 areas transforms your business value. The takeaway: business value isn't fixed. It's something you actively build. The 8 value drivers we covered aren't just theory. They're the exact factors buyers evaluate when deciding how much to pay. Pick the 2 or 3 that represent your biggest weaknesses and focus your preparation time on improving them. Small changes in these areas compound into significant value at sale time. Thanks for watching. If you found this helpful, head over to torchapp.io/signup to create your free account. Torch uses AI to help you navigate buying or selling a small business, whether you're just exploring or ready to make a move. And don't forget to subscribe for more episodes from the Torch Academy.